The global strategy is a natural extension of our investment process, and it picks up on specialties that the investment team have a lot of experience in our prior careers. It's designed to provide a defensive source of allocation across the G7 global governments around the world, invested back into a US dollar class. For Australian investors, this gives them wonderful diversification benefit, but also we have the optionality for investors to have a hedged to Australian dollar or an unhedged exposure, and that exposure will sit in US dollars. At a time of material stress, we often see that the US dollar appreciates very quickly in a flight to safety or a flight to quality environment, which can make this a very powerful hedging solution for a portfolio in material stress. And we saw it perform really well on an unhedged basis for investors in the fourth quarter of last year. The fund invests in North America, Europe, and Asia. North America being the United States and Canada, Europe being the United Kingdom, Germany, Italy, and France, and then in Asia, predominantly in Japan. We also have the ability to take some satellite exposures in similar countries, but we make sure that everything is always investment grade and sovereign or government backed. Very similar to our domestic strategy, we want to provide something that is very transparent, very highly rated, and very liquid, so investors can have great certainty that their capital is working hard and returning and generating returns that are backed by governments. So the Global Fund offers up a series of solutions managed by a team that have vast experience in very senior positions all around the world prior to managing this portfolio. It offers up a large opportunity set through the sovereign space, which is a very high grade and defensive solution, but with the added currency benefit can generate material return, as we saw in 2018. But with the switching optionality that we're offering investors regarding hedging at no cost, it allows investors to make their own choices around their currency needs or their currency outlook and switch between an unhedged allocation to a very high quality defensive series of assets or a hedged allocation as they see fit on a daily basis. Currently, the portfolio has a large overweight to US Treasury securities bonds issued by the US government. They earn very high rates of income after the Federal Reserve has hiked interest rates over the last few years, really generating a very stable return stream for the fund. And that's probably our largest overweight at this point. We still think that the economies are suffering under that rate hiking environment, and it is likely that bond assets could perform quite materially should the Federal Reserve or other central banks need to either cut rates or provide more accommodation for economies where there would be substantial capital gains from these instruments as well.